while the European Central Bank is working on some digital euro, they have potentially not fully understood what the case of stablecoins is and what the strategic value of it can be. And I think the actual potential negative outcome in the future down the line is literally geopolitically. If a lot of the trade is moving on chain, euro just has no substance on it. This will have an effect on the strength of the currency, I believe. With the Clarity Act, what I'm reading and seeing is that banks are very, very kind of like afraid of stablecoins being yield bearing, because that could mean a lot of outflow from their accounts, right? If the consortium is only doing this because they want to ensure that this stablecoin is not yield bearing and that it has kind of like certain disadvantages so that their core banking products are not under any competitive threat, then obviously I think it will not really change anything and it will also not become a success.
Most conversations about institutional crypto focus on what is being adopted, but very few ask who is funding the infrastructure that makes adoption possible, and whether Europe is building the right things at the right time. Today's guest is Gerald Pollak, principal at 3VC, a Vienna-based European Series A fund with 150 million euros under management. In this conversation, we cover what the European VC looks for in crypto and Web3 infrastructure bets right now, which layers of the stablecoin stack are worth building, where the real value in tokenization is being captured, and how AI and blockchain are converging beyond the narrative. We also cover what founders operating at the frontier of this infrastructure are consistently getting wrong in 2026. Gerald, thank you for joining me.
Thanks for the invitation. Happy to be here.
You built BlockTorch from scratch, then moved into BD at Third Web, and now you're deploying capital at 3VC. That is an unusual career path. What does moving between those three roles teach you about the infrastructure layer of crypto that you could not have learned by staying in any one of them?
So maybe even to go one step more backwards than starting BlockTorch really was, I was personally just curious learning about DeFi in like 2018, 2019, really. And so because I was at the time already learning code, I started to also learn Solidity and really go into kind of like the infrastructure levels and the tech side of what this whole new blockchain thing is. I mean, wasn't completely new at the time, right? But it still felt very, very early. And then at that time, I was already working on the VC side, so I also started looking at like new companies, whether they might be potential companies to partner with and to invest in. And from there, actually, my curiosity around the interest rate of Web3 started to evolve and develop, which eventually led to actually me co-founding BlockTorch, because I saw the gap in the market from like a user standpoint, a developer standpoint, and also an investor standpoint. So I think, while in retrospect it might look very non-linear in terms of the journey, and really kind of like the BD role at Third was a result of Third acquiring BlockTorch, so that was kind of like just an evolution of it. It actually was way more linear for me than it might look from the outside, which was just like I personally started being a user, I personally started being a developer in the space, and from there the things moved on.
I see. So let's explore the investor lens. 3VC backs companies with global ambition at Series A across a broad technology mandate. What is the specific thesis that brought crypto and Web3 infrastructure into that mandate? And what has changed about that thesis since you first started developing it?
So in general, at 3VC, we're a technology investor. So we are investing across the software stack. And obviously, over the last like 10 years, blockchain technology has been one of those paradigms that emerged as a software category. It has changed, obviously, a lot. We actually, a couple of years back, we backed an infrastructure company called Tatum in the space. That was the very early days where like Alchemy and QuickNote and Tatum and Consensus and so on, they were all just kind of like getting started to some degree. Today, the space looks very, very different, right? We are an equity investor, so we are absolutely not in the business of investing in liquid strategies or tokens. But I think nowadays, our interest lies very much on like the way how the financial system is being reinvented and upgraded and changed. And this, I mean, RWA, for example, hasn't been a thing like 3 years ago, for example, right? So the Web3 space is changing relatively fast. And we see it as one technological paradigm that is developing and very interesting and has strong effects and impact on the economic setup of how the economy works, in that case, especially on the fintech side. So it has never been a clear mandate of, okay, we pursue one clear blockchain investment strategy. We're a broad technology investor. Blockchain is one part of it, and within it the space itself evolves. And so we nowadays maybe look more into kind of like, for example, okay, how do stablecoins empower agentic commerce, for example, yeah, which 6-7 years ago wasn't the case at all. So I think that's just like how it changes based on what the market is developing towards.
Makes sense. Also, you have posted publicly that the debate is no longer whether blockchain-based systems will become standard, but when and how quickly. From an investor's perspective, what is the evidence that supports that conviction beyond the narrative?
So I think when we look at like the financial system, and we do see that like large financial institutions very, very seriously work on adopting the technology, then it doesn't look like a hype or an experiment or R&D. Like it moved beyond the R&D stage into actual strategic initiatives. Like when you look at like a BlackRock and so on, like what they're doing with Securitize and many others, right? So I think that is one clear sign that this is to stay. Like we're not in a phase that is kind of like going to just be a short period of time, and then blockchain technology will lose relevance. I think very large, also traditional finance players, payment networks are adopting the technology. During my tenure as a founder and afterwards at ThirdWeb, we have also worked with many of those players directly, and have seen inside out what they're working on. And this is by no means experiments. This is like actual production implementations that are being rolled out. And I'm really talking about, in this case now, the financial industry. Obviously, there is a lot of like other areas in Web3 that are like very, very experimental and to some extent short-lived, and might not kind of endure in the long term.
When a Web3 infrastructure company comes to you at Series A, what does the institutional adoption angle look like when it is done well, right? Versus when it's just bolted on to make the pitch sound more serious?
There again, it very much depends on what the company exactly builds, right? So I don't know, let's say a company is building like treasury infrastructure, then obviously, for example, the amount, like the dollar value in the treasury is like a signal of how big they are, right? But then if this is like an actual dev tooling company, like other metrics like the amount of developers active on the platform, like the number of API calls per day, etc., are very, very relevant. And like there is no treasury or TVL type of metric related to that, right? So I think it very much depends on what the underlying company, what are they building, what's the product. And irrespective of this, if this is a blockchain related company or Web3 related company or just something completely else, often companies have a so-called North Star metric. So one key KPI that kind of defines for them what success looks like. And so we always like to understand, what is this North Star metric? How is it developing? And like, what's the future going to look like? But in general, for us, Series A and seed rounds are rounds where we have clear signals and clear demonstration of product market fit. So teams should be beyond the pure stage of experimentation of like, what is a problem they want to solve, who they want to solve it for. Like they should have a relatively clear picture on what that is at the given time. Things obviously might always change over the longer period of time, but at the point where we are really considering partnering with them and building conviction, we want to see that there is a very clear product market fit signal in place. And as I said, this depends on what the company actually does in terms of product and underlying success metrics.
You mentioned Tatum. What's the North Star metric there at the moment, and how is it going to change later down the line?
I can tell how it is changing down the line, right? But it's a developer tool, so they're very obviously like the number of developers and the usage metrics that follow from that are very important. So how many apps are actually being utilized? Like how many apps are utilizing the tech stack, and how many developers are relying on the infrastructure?
Venture is a long-term partnership business, right? And you have said that a few times. What does that mean in practice when you're sitting on the board of a crypto infrastructure company? That is 3 years in, for instance, right? And the market has moved in a direction nobody has anticipated.
Yeah. I mean, at the end of the day, markets can change, right? I mean, I've experienced it as a founder myself. We started building early 22, end of 21, early 22, and then end of 2022, FTX imploded. And like for us as founders, this changed the whole market. I mean, that had massive impact on everything, right? And then as we were building, like the market went through numerous changes, like the whole development of L2s and L3s were not a thing when we started out, and then they really became a hype. But like like everybody suddenly was set to start their own rollup chain, which by now I think also is not the case anymore, right? And then RWA started to come in, and like you had a lot of attention on that, and in between there are like the agentic token launch platforms and stuff like that. So there's a lot of change all the time. I think in Web3, what's really important also in the long term relationship and working with teams is to, on the one hand, not lose sight of what is the long term goal, right? But at the same time, be agile enough to iterate and to adapt on the market changes. And then it really comes down to kind of like being a sounding board in the sense of like, are we on the right track? What what would enable the team to move faster, for example? How can they maybe eliminate certain risks or certain barriers that they're facing, and how can we as investors enable them, help them, or also sometimes just be there to listen to something that they have on their mind and try to bring new viewpoints on the subject matter, and with that help them move forward, or make them the right intros to the right hires or an expert or a client, right? So really it's about kind of like creating value and helping the team move in the right direction, and making sure we're checking in that kind of like this is the case, and whether we are overlooking something or whether we are on the right track.
I had an interview. It just came up to my mind. I had an interview with a person whose whole company is focused on helping institutions to hire, right? And he's been mentioning that VCs have a lot of voice in this, and sometimes it's not necessarily helping the process, not all the time, for sure. But if I suppose because cases differ, teams differ, and sometimes VCs they have a lot of companies in their portfolio. Maybe that's the reason. But what's happening in your case? How deeply embedded you are in the hiring, and do you think that there should be more space for free? No, I wouldn't say free choice, but in a way, freedom for founders of those companies to choose the right people for themselves.
I mean, we're absolutely not kind of like telling founders who they should hire. Yeah, we are we are very high conviction investors at 3AC, so we have a very small portfolio, and that allows us to be true partners on the side of founders, which really means we want to be a resource that they can tap, but we are not telling them, hey, you need to hire person X or person Y. However, what we're very happy to is like, okay, let's say we have figured out, or let's say some key person left the company, right? And so obviously, like there probably needs to be some way of replacement of the person, and we are very happy to strategize with the founding team and be a sounding board of, okay, is there maybe like internal talent that can cover here, or is it maybe some external person that should be hired, and then we also have like experts in our network where we are able to make introductions to say, okay, maybe we can help you fine tune your talent strategy, or kind of find the right headhunter to find the position. We are also happy to interview the person. Like if this is something the founding team would like us to do, but this is always very much kind of like, is this a help for the founders, and would the founders like us to do it? It's not that we go there and we're like, send us your 3 profiles for person X, and we are going to like make the interviews and then give you a decision who you should hire. This is not the case. This is not how we are running our way of understanding of what we see is like.
Let's talk about stablecoins. The stablecoin stack has layers such as issuance, custody, settlement, distribution, yield, and so on. From an investment perspective, which layer is defensible as a business, and which ones are being commoditized faster than companies can build them?
So it's a hard question, I think, but a very good question that we obviously also think about when looking at companies. Is like, okay, how defensible is it, and where are we moving? What we have seen over the last years, I would say, is that the pure node infrastructure side of things became very commoditized. So if you just need some access to like, I don't know, let's say Ethereum as blockchain, like you have a ton of options, many of them are free, and there are nuances that make differences, and they pretty much got commoditized. There to some extent, some elements are kind of like have certain network effects embedded that make a bigger moat. And one example for, like, I mean, maybe not really network effects, but more like utility. Let's say you have a stable coin, and the quality of the projects that embed vaults with your stable coin might matter, right? I mean, if you get listed with your stable coin or with your vault on like very large platforms like Morpho and Aave, like, right, this means a different thing than if you're just partnering with very small up and coming DeFi projects, for example. But as we are not investing into liquid tokens anyway, so we wouldn't invest in like into a stablecoin straight. We would rather kind of like look at like plays that get enabled through stablecoins, like infrastructure for payment processing, for example. So I think it's a very hard question to say kind of like what is going to be commoditized and what's going to be a moat. I feel like right now there is a lot of like gravity and gravitational pull towards the very large stablecoins. So USDC, USDT, right? And then there are whole kind of like ecosystems forming around it. I mean, Circle, for example, they even launched their own chain called Arc for making USDC swaps as easy as possible, with like a certain liquidity hub and stuff like that. So I think it's a very hard question to answer what is being commoditized, what's not. I think certain things have more modes than others, but let's see where this is actually moving.
The euro stablecoin market is a fraction of the dollar stablecoin market, despite MiCA creating a clearer regulatory framework for EMTs, e-money tokens, that than exists anywhere else in the world. What is the honest diagnosis of why European adoption is this low, and who has the most to lose if it stays that way?
I can't give you a clear answer of why it is slow. I mean, I only have a hypothesis there. That the first euro stablecoin I have seen was, I think, back in 2022 or so, from Angle Finance or Angle Money, like French team that launched one. I don't know where this went or when they have stopped it. Obviously, you have teams like AllUnity working on it too. You have like a Circle, Euro C. One hypothesis could be that just a lot of like international trade has been settled in dollars, and so maybe to some extent dollars was just closer to the economy that went on chain these days to use stablecoins. I think another element obviously can also be regulation and also politics. I think in the US, at least to me, it seems there is a lot of like political interest also in adoption of USD denominated stablecoins. USDT is by now a holder of a huge amount of US treasury bills, right? So that has also political implications. And in the EU, I mean, as with many things, we just see that the EU is rather slow on solving certain problems or agreeing on certain directions. And I think while the European Central Bank is working on some digital euro, they have potentially not fully understood what the case of stablecoins is and what the strategic value of it can be as a union and also as a continent. And I think the actual kind of like potential negative outcome in the future down the line is literally geopolitically. If a lot of the trade is moving on chain, and euro just has no substance on it, this will have an effect on the strength of the currency, I believe. But this is a very political question.
So basically, stablecoins serve as geopolitical tools now.
I mean, they're a currency, right? I mean, they're a currency, and you could argue that while no central bank today, at least, is kind of ruling or governing the main largest stablecoins, who knows where this is heading? Maybe they will in the future, and I mean, if we're gonna adopt one currency or multiple ones is a different question too, right? The whole question of FX is also there, like how it is actually backed and what it is pegged to, etc. If you look at Argentina, like people literally hold like US dollar denominated stablecoin in their accounts from their salaries, because this helps them to not be too much affected by inflation of their underlying home currency. Why are they not holding euro stablecoins? Because it wasn't there, I guess, right? It was just kind of like an adoption, like USD was there and was faster, and US dollars still are meant to be a very, very kind of trustworthy currency, right? In general, like dollars in general are a trustworthy currency globally. And I think the euro could have become that, but I think the policymakers have been maybe not enforcing it with the right priority.
Let's stop for a minute. Here's a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. I think it's the right time to talk about Qivalis, right? They just announced a consortium of now 37 European banks building euro stablecoin infrastructure on Fireblocks. Bank consortiums have a long history of announcing infrastructure projects that leverage commercial scale. What would have to be true about this one for it to be different? Do you think it's just the new times and the necessity at this point to come up with the alternative, more native alternative in a way, right? Or there is something else as well?
So I think, I mean, in Europe, there is like on the one hand, I think the digital euro project is trying to enforce to make every merchant accept this digital euro, right? If this is the case, like it already puts any other project in like in a disadvantage. So even if the consortium is launching another euro stablecoin, if like there's a barrier that is created for this stablecoin to be adopted in on the internet as a payment flow, like, or in general in payment processing, that obviously will already be a disadvantage and might lead to failure. But I think the way bigger aspect of that is, and I don't know, because I don't have close enough ties to the people actually in those premiums, would be, are these banks truly trying to innovate, or are they just trying to launch one so that they are in the position of saying, hey, we have something as well, and then just protect their own interests, right? It's like where with the Clarity Act, what I'm reading and seeing is that banks are very, very kind of like afraid of stablecoins being yield bearing, because that could mean a lot of outflow from their accounts, right? If the consortium is only doing this because they want to ensure that this stablecoin is not yield bearing and that has kind of like certain disadvantages, so that their core banking products are not under any competitive threat, then obviously I think it will not really change anything and will also not become a success. If they truly want to innovate, could be an interesting project. Let's see how that goes.
You mentioned AllUnity. You also mentioned Circle, right, with their URC. Can those coexist together with what consortium is coming up with? Maybe I don't understand something, but isn't this can it go hand in hand or coexist or move in parallel, or what is the picture, right? Where are we heading with this?
Now, good question as well. I mean, technologically, obviously they can coexist. I mean, anyone can just, in theory, create a stablecoin, right? That's the beauty of decentralization. In terms of like, can multiple ones be big adopted stablecoins? I think we see that right now with like USDC and USDT that it can be the case. I know like 2 years ago at like I'm not sure if it was like it was like a digital asset summit in New York, where I think it was PwC. They announced that basically every major US bank will launch their own stablecoin. Whatever the purpose of that is, right? Like maybe there are certain utilities that will be different, and then all of them will just be interchangeable. Um, I think yes, there is a case to be made that multiple euro stablecoins can coexist with them having different type of like advantages for the end user. Let's say some of them, for example, are yield bearing. Some of them might be have certain advantages in like depositing and lending. Maybe some others might have other utilities, like especially usable in like payment settlements. Who knows? Yeah. I think the very interesting element of the then is how efficient does the market get, and will at the end of the day every euro stable coin be worth an equivalent, or do we see some fuck ups where like suddenly there is a depack of one of them, right? And like it's evaporating um, a lot of like capital. I think that we have to be careful of is like that every larger project is actually has a utility to why they exist, and that it's also secure for the end users. Um, and at the end of the day, like the economic value of it has the underlying efficiency that the market should have.
You know, it's really interesting because, as I said, in US, every bank is coming up with their own stable coin, and this looks like from the side, this looks like you know a healthy competition in a way, right? And if it's interchangeable, why not? But here in Europe, it looks a bit differently because there are banks and there are some privately held like companies and organizations. How will this go? That's a really good question. It's interesting. Maybe I will get a chance to ask them, by the way, directly about this. Let's see. Now, when it comes to tokenization, from a VC perspective, where do you draw the line between a tokenization company that is building something durable and one that is essentially a wrapper around existing financial products with a blockchain label attached?
I think by default, like a wrapper around maybe existing other products doesn't need to be seen as like something negative per se. Yeah, if there is like a specific kind of like value creation, a specific niche that they're positioning in, obviously there are certain products that are more of like an extension of TradFi. And to be honest, I think they likely might also be the ones that get adopted faster because they might be understood faster by the general public or by their target user base. And simply make certain assets more accessible, more liquid, more easily tradable. And I think that is absolutely fine. And then there are others that really try to innovate on like an asset class, for example, and come up with very very new settings. And there, I think there is way more way to go to prove that long term this will hold. Like capital markets are relatively old to compare to what the technology here is, right? And so if you try to innovate a lot, like with almost on the R&D front on tokenization, it is probably just a much longer way towards proving that this is something that will endure versus taking existing concepts and to some extent wrapping it on chain and just using blockchain for the same. It has been used before, but with certain elements that are improvements of the TradFi system.
The way I understand it, you have seen tokenization from the infrastructure side at BlockTorch and from the capital allocation side at 3VC. Now, where is the tokenization? Where in the tokenization stack is value being captured in a way that compounds over time, and where is it being extracted once and then computed away?
I think like on the capital allocation side, like or in general on the capital market side, there is more value that will compound on tokenization. I think a lot of the infrastructure that is required for it is likely going to move towards commoditization, because the blockchain by itself is decentralized and very accessible, right? And so the infrastructure side of things, like the technological part of tokenization, is, I think, rather trivial to being able to actually be a true player in the capital markets with it. And so I think it will matter really, are you able to bring on the large asset managers, right? It's like, are you able to partner with them? Are the assets that you're bringing on like the ones that really will create a lot of value in the long term, rather than the pure technological underlying, which to some extent could be commoditized, likely.
The tokenization narrative assumes that putting an asset on chain creates liquidity. Now, liquidity requires buyers, market makers, and settlement infrastructure that has nothing to do with the token itself. Which of those three is the hardest problem to solve, and who is the closest to solving it in Europe?
I don't know who is the closest to it of solving it. I think actually like the liquidity is the hardest part of it. Like and the market makers, like being like nowadays also, especially with AI, like building products per se, or like launching a token or tokenizing an asset is to some extent, I said, relatively trivial. So people can do it. Like, I mean, on the testnet, especially, like we could just do it. Like we don't need anything, right? We could do it for a hackathon project, etc. If you want this to be production ready and really have like hundreds of millions or even billions deployed on it, obviously the tech needs to be very, very good and like stable, and like obviously it needs to be very trustworthy. But being able to get this whole capital markets players on it as well, and choose you as the provider of, for example, a specific asset. Yeah, I don't know, let's say tokenized corporate bonds. I mean, you need all those partnerships. You need all the trust from them. You need to have the relationships. You need to bring all of this on once you have this product set up. And I think that the pure setup of the product from the technological standpoint is important to be done right, but it will not guarantee success as long as you don't manage to kind of like also have the part of like the relationships with the capital markets covered.
I think it's a good time now to switch to AI and blockchain. The AI and blockchain convergence narrative is everywhere right now. Where have you seen it produce something that could have not been built without both, as opposed to something that is simply two separate products running in parallel?
Yeah. So I think where it's most obvious that this hasn't worked before in any other setting is where it really is like agent to agent payments. There are people arguing, yeah, but you can just give a credit card to your agent and you can also set up rules for it. But I think this is not programmatic in a sense as you can do it with for example, stablecoins. And I do believe that in the long term, we will move a lot towards like outcome-based pricing from pure usage-based pricing. And so, in my opinion, to define outcome-based pricing, there will be a certain underlying infrastructure required to say, okay, first of all, yes, the outcome has been delivered. Second of all, what has been the quality of the outcome? What is the price for that type of outcome? And also like even a mechanic that would allow you to dispute and say, actually, no, wait a second, the outcome was not as it was defined, or not as good as it should have been. So maybe we just overpaid, right? And this will be agent to agent. There will not be a human in the loop. And so this is all purely programmatic. And an agent will never pass KYC because it's not a person. So an agent will never be able to truly open up a bank account. If you want this to be efficient, it needs to be in real time, and then it cannot matter where in the world these two agents are actually sitting, communicating with each other. So I do think, like, when it is about agent to agent payment flows, then like the X402 protocol, for example, like is a clear example. Would have not made a ton of sense without agents, because humans can just use the existing payment infrastructures, and then basically without blockchain, agents can also not really in that efficient way be able to process those payments.
AI agents are being discussed as autonomous economic actors, right? That need to hold, send, and receive value on chain. That's what we have established here as well. How far are we from it working at an institutional scale?
I think we're still at a very experimental scale. So I think we're not very far in institutional scale, but that has a bit of like a dependency on first the agent to agent value creation, right? I mean, we do not see so much agent to agent economy existing yet in like a pure product value existence. Obviously, you will need the necessity for an exchange of value, and for that, currencies are an exchange of value. You could also argue agents can also trade knowledge, right? Like they can just exchange knowledge or data for each other, and do like a barter trade instead of actually paying the other agent. But so I think the dependencies first, like the use cases need to mature where agent to agent really makes sense. And then with that, we will see a rise in also institutional adoption of agent to agent payment flows. But I think a very interesting concept, for example, I've discussed the other day with a founder, was if you have content, like media content, for example, that is behind a paywall, and the agent for some reason would like to access it, or only parts of that, to access specific knowledge on a specific research topic, for example, then in theory, like the agent could pay and get the snippet of information in return, right? And that could be fully autonomous on chain, right? I just don't think that we are at the stage yet where this is actually done in production. So it will take time for the product to develop, and kind of like for the whole economy to develop a bit on the agentic side. And then with that, we will see a broader adoption of, probably in the beginning, different payment innovations. And then one of them eventually will kind of like become the winner in it. And I do think that this could be on chain with like stablecoins, even though we also see alternatives that are tried to be set up from like other agentic payment providers, like traditional payment providers going into agentic, right?
When you look at your deal flow at the AI and blockchain intersection, what is the ratio of founders who have a real technical insight to founders who are pattern matching on what LPs want to hear right now? And how quickly you can tell the difference? We
No,
can take into consideration also not only your deal flow, but what you are seeing, maybe when it comes to your partners, friends, and so on.
I mean, to be very frank, I mean, we see a lot of AI deal flow. We are not seeing that much amount of like blockchain meets AI deal flow, to be very honest. Where I have seen a lot of blockchain meets AI topics was like when I was still at Third Web, when we I don't know, participated in hackathons with our infrastructure for builders to build on. There was a time where like a lot of AI meets blockchain teams have started. I don't know how many of them matured. There were all type of like things, from like AI agents that would understand your on-chain behavior to give you recommendations, to AI agents built on the fly index funds based on risk appetites and stuff like that. On the VC side, I haven't been seeing any of those, to be very frank. At least not at Series A stage in Europe. It's a bit of like stablecoin banking, so more like on the banking side, it's a bit of stablecoin payment rails for the agentic commerce. But then the whole AI side is just not touching the blockchain elements of it.
What is the crypto Web3 or AI infrastructure category that keeps showing up in your deal flow that sounds compelling, but almost never works in practice, and why?
I think a lot of like the things that have a hard time really working in practice is when they don't have a true problem they're solving, where it's like very from moral or ethical reasons we're thinking, okay, we need to decentralize something for privacy reasons, etc. But there is a very shallow level of true problem solving underneath. I don't have like a very concrete example for that right now, and it's also not super related to like the stablecoin element, but it's like in general, like we like to say we want to see hair on fire problems, so problems that are really on top of mind for the buyer and that they're ready to also spend money on because they get true value from, and usually when someone gets true value from something, they're ready to pay. And over the last like years, also as a founder in the space, I have seen a lot of Web3 projects that do not create any value per se for the buyer to solve a problem, that are just like very idealistic or like maybe good ideas, but they just don't kind of deliver the type of value that they initially planned to. And so it's a lot of like pump and dump schemes that we have been seeing over the last like 5-6 years in various types of flavors, and they're just not sustainable. If they're not making true revenue, for example, like it's just not sustainable. They don't have a sustainable business model, and people see them as a nice to have.
Both in Web3 and AI, there is a difference between infrastructure the market needs and the infrastructure the market will pay for. And we've also kind of elaborated on that. Where are those two things most misaligned now in Europe?
So, I mean, infrastructure for AI is very different to some extent to infrastructure to Web3, right? So infrastructure in AI is a lot of like compute, for example, and a lot of hardware actually nowadays. And it also is like a lot of cloud infrastructure, while infrastructure in Web3 is very focused on like nodes and like RPCs and wallets that are non-custodial or custodial and so on. So very, very different, I would say, in like what I would see as infrastructure layers in those two categories. And I think a lot of the infrastructure in Web3 is solved nowadays. So I don't see a lot of problems existing with infrastructure in Web3 today. I think in AI, because like you have like more and more workloads, you need them on the edge. You have an increase in amount of compute capacity required, and so on. There is a lot of like topics that need to be solved there. You need the electricity and everything, right? So I think the infrastructure side of AI is a bigger problem today, and that's also like a bit more interesting, and more very talented brains are thinking about how to solve it and start business in the area.
If you were a founder today with deep technical expertise and wanted to build the infrastructure company that institutional crypto in Europe needs most, what would you build and why? Because I've got this impression so you just said that there are no problems with infrastructure, right? Would you still build something, or that you see now with through your own perspective, through your own lens, with your own experience, right, from your position, or would you prefer something else, and why? Yeah.
So if I would start today, I mean, first of all, I would go to like institutional providers and ask them, okay, what are the biggest problems you guys have, and try to figure out what these problems are. My hypothesis would be that right now, I do not think that there are infrastructure needs that are truly unsolved for institutional crypto adoption. Maybe I'm overlooking something, but I think to what I have seen, the largest extent of required infrastructure for true institutional adoption exists. It's just that there are regulatory topics maybe that why they have not started to adopt it. Maybe it's like also like just strategic options that they have where it's not a priority for them to go really deep on tokenization, things like that. But I think the pure infrastructure that is required, especially from a technical insight, like anything from like auditability to the security side, to the observability side, to the pure like chain access, no matter if this is a private networks or public networks, like I think all those things exist in the market. Maybe not to the extent that they let you customize on a very specific kind of like institutional requirement, but overall I would say they exist and they're covered. So I would rather not probably start an infrastructure company in the space right now.
Now, as for the closing question, where is the best place for founders and operators in the space to find you and follow your work at FreeVC?
Yeah, so I mean, on the one hand, obviously LinkedIn, also Twitter, I'm very active there, or X. I also post some thoughts regularly on Substack. These are all places where I'm responsive, and then I'm mainly in Europe, and so I go to conferences and events and so on in Vienna, Munich, Zurich, Berlin. Haven't been to any ETH conference recently, but maybe we'll also do that soon again. But yeah, X, LinkedIn, Substack are the places to find me.
I will include all the links. And yeah, so thank you very much for joining me today, Gerald. And I think this has been a different conversation from what I usually do. And exactly what the institutional crypto infrastructure discussion in Europe needs more of. Sometimes it also needs to, to redirect its attention towards what's really truly worth building, right? And to everyone listening or watching, like, subscribe, or follow both of us, and share this episode with someone curious.